Good afternoon, everyone. Well, almost good evening, and thank you all for joining us. My name is Peter Warda with the SCV Chamber of Commerce, and I'm pleased to welcome you all. As always, as you know, throughout the webinar, please use the questions feature in your control panel to submit any questions you have. And if you are experiencing any technical difficulties, just email hello@scvchamber.com. We're monitoring that email live throughout the webinar. Just want to make a quick announcement before we do get started. Make sure to constantly check our events page on our website, www.scvchamber.com. You'll see the events tab to register for all our upcoming events and see what we have coming up. Just to announce one quick event, as you know, we recently announced our newest member benefit, which is our Chamber 401k retirement plan. And so we're going to have a workshop on Tuesday, December 8th at 1 o'clock. To kind of go over what that'll entail and how it's going to work. So don't forget to register for that one. For today's webinar, we're joined by John Vance, President and Visionary of Vance Wealth, and Lisa Odom, Partner at Poole, Shaffery Koegle. So they're going to discuss proactive planning strategies to give your business a head start in 2021. So the first portion of the webinar, John's going to go over different business and tax planning strategies, and some of those will include payroll decisions for owner and owner's family, retirement plan options, and year-end plan of action. And then Lisa will handle the legal matters, and she'll go into management and asset protection, entity formation, company filings, and qualifications. So I'd like to give you a little background about our presenters. Since 2003, John's strategic vision for Vance Wealth has been steadfast, and it's creating a financial investment practice with the singular focus of helping clients achieving more than they could have ever imagined. John is both a certified financial planner professional and a certified divorce financial analyst. So his plan-driven approach has been a major factor in helping Vance Wealth's clients reach their financial goals and feel confident in their financial future. So welcome, John. Lisa Odom is partner at Poole, Shaffery Koegle. She represents numerous individuals, families, and small and mid-sized businesses with respect to estate planning, trust administration and probate matters, contracts and business law matters, business formation and dissolution, asset sales and stock purchasing agreements, commercial and retail leasing matters, trademarking matters, and complex real estate transactions. So thank you, Lisa, for being here. To summarize about both of our speakers, if you're getting a divorce, see John Vance. For everything else, go to Lisa Odom. But with that, I will go ahead and now turn it over to Lisa and John. So it's all yours. Thanks.
All right, thank you, Peter. So I'm going to get started with just going over some small business financial planning ideas. Unfortunately, we are here in December, and I know a lot of our planning tends to start at the end of the year. And for some of you, we might be able to, get in some last-minute tax planning, some last-minute financial planning. But hopefully, this just really kind of sets the stage for next year. So it gets you thinking ahead. So that we can make, next year the best to come. So what I'm going to actually do today is just cover a few topics, and then I'm going to hand it over to Lisa. So Peter had mentioned that there's a new 401k benefit for the chamber, and while I'm not going to go into the details on that, I am going to spend a little bit of time on what some of the retirement plan options are for business owners. And this really goes from the sole business owner, meaning just one, maybe they're the only employee or they're a sole practitioner, all the way up to companies over 100 employees. So when you start thinking about what the main options are, now this is a simplified list of retirement plan options, but I wanted to kind of go through these choices because being in California, basically our California legislature has passed law that's going to require businesses to have a retirement plan in place. And so on the right-hand side, you can see there's some different deadlines. So if your business is over 100 employees, the deadline was actually June 30th of this year. It did get extended till September 30th due to COVID. So if you're in that group, hopefully you've been contacted by your professionals. You've already been taking steps to get a plan in place. But there's some important deadlines that are on the horizon as well. If you're over 50 employees, the deadline will be June 30th of 2021. So that's right around the corner. That's 7 months. So if you're in that group, it's time to plan now because it does take time to get these things in place. And then if you're 5 or more employees, then you have until June 30th of 2022. So, when you look at these scenarios for all businesses, except for those between 1 to 4 employees, they're going to be required to have a plan. So what I wanted to lay out here, there's a lot of weeds on this slide, but I wanted to lay out kind of the more typical options that we see, whether, again, if it's 5 employees, 10 employees, 50 employees, the different options. So California has put together a plan called CalSavers, and that's the first plan listed on the left-hand side. I know it's for workers in the state of California. It does the maximum annual contribution amount is $6,000 and $1,000 catch up if you're over age 50. There are no employer contributions, so the employer can't put in. This is only contributed by the workers. And so if you look at, that's kind of the baseline offering that the state, it's basically a plan that the state put in place. I'm not a big fan of those. I think that it's not a great option. I think as business owners, there's much better choices, not only for you as a business owner, but also for your employees. So I'd really encourage you to work with a professional and explore these options. We have a simple IRA, a SEP IRA, and a 401k plan. So the simple IRA, a lot of times while people will use that, is some of the compliance costs of using a simple IRA are on the lower end. So that oftentimes can be for somebody who feels like they really want to keep costs down. And I know that's always a goal, but they really want to keep costs down as well as funding down. But this is only for businesses less than 100 employees. So sometimes a simple can make sense. And then you have a SEP IRA. A lot of, I would call, solo owners or individual owners are familiar with SEP IRAs. Because that's what they've been funding for their, basically their whole business career. But one of the things I would really encourage you is the 401k plan is by far the most robust one. So depending on your size of business, I would really look at exploring whether a 401k makes sense for you over some of these alternatives. I would encourage you to look at the Chamber's plan. We know the Chamber can help you, or work with your professional and see if there's a plan that will work for you. So I'm not going to read through all the slides, but one of the things that I do love about the 401k plan, it does allow in what I would call a lower income year for business owners to fund a lot more money in there in a Roth provision, which can grow tax-free potentially, and or like a profit sharing account, which would be tax deferred. So a lot of options there. These are things that you want to talk to a professional about to make sure you're well versed in. So I'm going to move on to kind of the next concept. There's a lot of moving pieces to this one. So payroll decisions. Now, I would probably put this conversation into those of you who are running a business that's, let's say, less than 10 people. Now, this does apply to all businesses, but I think that if you're in that category where you're a smaller business, or again, maybe only an owner-only business, so no employees, the decision on how much you pay yourself has such a significant impact on other things. And a lot of times, people aren't even aware of actually their decisions. And so let me just walk you through a couple scenarios. And so the idea around payroll taxes, I'm going to try to give you a couple examples. So under payroll taxes, I have a bullet point there that says, 1, be careful paying yourself too much. Well, that sounds kind of silly, right? Pay yourself too much. Well, we should all know that when you pay yourself, you have payroll taxes due up to the Social Security threshold, which is just over $130,000. So you're going to pay a healthy payroll on that Social Security tax up to that wage level. And when I say be careful if you pay yourself too much, a lot of businesses that we've been working with have had a down year this year. And a lot of businesses are going to have basically negative net income or a loss. And the reason why you want to be careful about paying yourself is if you pay yourself in payroll, and you have a loss in the business, then what happens is you've created an unnecessary payroll expense, an unnecessary payroll tax. Had you actually reduced your payroll somewhere throughout the year, you would have been in a much better position. And so a lot of times we see phantom income where people overpaid themselves by $50,000, and that actually created an additional $5,000 in payroll tax. Totally unnecessary. And some of that is just because of lack of planning. The other thing from a payroll perspective, if you have any family members that do work in the business, whether that's a spouse or whether that's children, assuming they actually are doing work, they have a job description, then I would really look at considering adding them to payroll, especially as we go into year end. There might be by putting them on payroll, you potentially could reduce some of your personal income taxes, as well as open up some opportunities for like retirement plan funding, which is actually the next concept I'm going to go through. So please know as we go through this, make sure you work with your tax professional when you're considering these options. You know, when you consider payroll issues, these are bookkeeping issues, these are payroll tax issues. Your accountant should know this, your financial advisor. So you don't want to just, I don't want you to come out of this workshop today and say, you know what, somebody told me I should do this. You want to carefully craft those decisions. But a lot of times there's not enough thought that goes into it. And so I'd really encourage you to be a little bit more purposeful about those decisions. So next item on here is retirement plan funding. So retirement plan funding, basically, if you don't pay yourself enough in payroll, then it limits your options with retirement plan funding. I had a business owner last year that paid themselves zero. They just decided, I'm not going to pay myself anything. Well, when it came to year end, they weren't eligible to fund a 401k, a SEP IRA, or an IRA. And that actually increased their taxes because they did not even pay themselves anything. So the decisions around whether you're going to pay yourself, if you have your spouse on payroll, then you have the ability to fund a retirement account for them. So these are all decisions that can help you put more money away for retirement, that can also help you potentially save some taxes. And so the retirement plan funding is a big component of the payroll decision. Now, the final one on here is business net income and the impact on something called qualified business income. Now, if you've been a business owner for the last couple of years, you're well aware of during the Tax Cuts and Jobs Act of 2017, there was a new deduction that was created for businesses. And now, not all businesses get it, but many do, and I would say most do. And it's called qualified business income, or QBI. And Lisa's going to go into some details on entity types, but you know, this is generally applicable to sole proprietors, partnerships, LLCs, S corporations. They can benefit from this tax deduction, and in many cases, it's up to 20% of net income. So let me say that again, up to 20% of net income. So in an example where you have 100,000 of net income, potentially you have an additional 20%, which would be $20,000 that you deduct against your income. So that lowers your tax liability. So the reason why this is all significant is there's a fine line when you're running your business. We all know as you take money out of your business, you can take it out in the form of payroll, or you take it out in the form of distributions. And so if you pay yourself too much, that gives your business more deductions. But then what happens? Your net income goes down. And the QBI deduction is based on net income. So if you push your net income too low, you actually might lose out on this really powerful qualified business income deduction. So that's where it's really important to have a fine line. What I would encourage you to do, kind of the action item coming out of this, talk to your tax professional and ask them, how much should I pay myself if I'm trying to maximize my QBI deduction? And they actually have the tools to go in and run the analysis and say, okay, based on this, now you have to pay yourself a reasonable wage, but based on a reasonable wage, they'll be able to actually calculate and help you determine how to maximize that QBI deduction. Now, we are in December, so some of you might be able to do that. A lot of businesses do like to pay themselves out at the end of the year. If that describes you, you still have time. But if not, just please use that as an idea going into next year on how to better position yourself. All right. So just real quick, I know we're going into year end, so I have just a quick offer. If you do have some questions on this and you want to have just a 20-minute conversation, if you're on this call, we'll give you a 20-minute complimentary consultation. So our number's at the bottom. You know, feel free to reach out. You can also find our company. It's Vance Wealth. That's it. I'm going to transition to Lisa. Thank you.
Hello, everyone. As everyone knows, it's been a very interesting year. And I know that we were, essentially closed down for several months in terms of, many businesses were closed down. We are an essential business, so we were not closed. But what was really interesting is we did think that there would be a slowdown because we assumed that since people weren't working and their businesses weren't open, that they would not need our services, but we were actually very wrong. And during the period of the sheltering in place, and even really, well, it sounds like we're sheltering in place again today, if I read the news correctly, but, or at least starting to close down things again. But even with that, we had a lot of people who were evaluating their businesses and looking at things in a much more global way. And we realized that a lot of people just really simply were not set up properly, or that they had holes in the ways that things were set up. And So I'm going to do just an overview of kind of some things that we saw during this process and talk about how to make sure that everything is really set up and that you're organized properly so that you can really hit 2021 cleanly and hopefully get back to regular life eventually. This is hopefully not the new normal forever, and your business will be set up in a way that you actually can be not worried so much about how your business, the functionality of your business. You can just work on making money and proceeding and knowing you're protected. So the first question is, have you considered what type of entity you have? Are you a sole proprietorship, a corporation, a partnership, or a limited liability company? In full disclosure, I'm not going to talk about partnerships too often today because simply people don't really have them very often anymore. So we'll start with sole proprietorships. So the first most important question as we enter into 2021 is, if you're a sole proprietorship, have you considered whether you might need some limited liability protection? Limited liability basically just separates your business assets and creditors from your personal assets and creditors. So it's a type of asset protection, although that's a much more complicated topic, but it does actually give you some insulation. So for instance, if you have an employee who wants to sue the company for something, theoretically, except for in certain circumstances, you would have some protection to your personal assets. That's the goal, is to kind of keep those two separate so that you can know that the things that you've earned stay with you rather than going to a creditor of the company and vice versa. So, so obviously limited liability is the first question we always ask our sole proprietors. Do you have any reason to have some limited liability protection? The second is, even if you're not worried about limited liability, are there some tax reasons why it would benefit you to have an entity registration such as a corporation or a LLC? And that I've seen many of our clients who make six figures start doing the analysis, especially now with the QBI discussion that John was just having. A lot of our clients have realized that there is some benefit to them from having to have a corporation or an LLC over a sole proprietorship, and they'll decide to form a corporation at the very end of this year so that they can have the benefit of those tax benefits for the following year. But even if that's not the case for you, and a sole prop is definitely the best way for you to handle it, one thing that we often find when we're working with our business clients is that their fictitious business name statements aren't current, or they have lapsed, or that they're not registered at all. Many don't realize that you're supposed to be registered in every county in which you conduct business. And even for our corporate clients or our LLC clients who are operating under an assumed name, so let's say your corporation is ABC Corp, but you go by some other business name, Sarah's Towing Company or something like that, you still do need to have a registered DBA, especially in that situation, to enjoy the limited liability protections that you sought by forming the corporation. So really making sure that your registrations are good is important when you have a sole proprietorship. Now, if you have a registered corporation, the question becomes, do you have an S Corp or a C Corp? One of the questions I get a lot from people is which has better limited liability protection. If you're running your corporation properly, it doesn't matter if it's an S Corp or a C Corp, you should have the same limited liability protection. But importantly, if you're a C Corp, I would say, have you confirmed with your CPA that your corporation status is most tax advantageous to you, or would you get more benefit from having an S Corp? C Corps are potentially subject to double taxation, so there is that issue. Also, have you filed all of your annual reportings with the correct entities? Like for instance, I don't know what happened here. Some of my slide got cut off, but you have to make sure that you've registered your statement of information each year with the Secretary of State of California. You have to file your proper tax returns with both the federal government and the state franchise tax board, so things like that. Then also, in considering whether you have a corporation or not, Is there one shareholder or is there multiple shareholders? If there's only one, are you properly maintaining separate accounts for your business and personal? One of the toughest cases I had this last year had to do with maintaining proper accountings with multiple partners. You know, you owe a fiduciary duty when there's multiple partners involved in a business, and maintaining proper accountings of, you know, business expenses, not commingling personal and business expenses, things like that. These can become huge issues and actually can become huge sources of liability and potential causes of action against you if you're paying personal expenses out of a business account. And you also could lose a lot of your trustworthiness with your partners. So these are things that you could really kind of dial in now that you're looking at 2020 from a, you know, sort of global analysis as you're going into 2021. The other really important thing when there's multiple shareholders is making sure that you have some type of shareholders agreement and buy-sell agreement that's going to handle not only how you manage the business as between you and maybe even the division of labor and things like that, but also what happens if there's a catastrophic event. If COVID taught us nothing else, it taught us that a pandemic can come through and you know, cause the death of a lot of people unexpectedly, or even if people didn't die, they might have been forced to quarantine for 2 weeks, or there might have been other impacts that, or other things that happen as a result of something unexpected that we really should be planning for. And so I can't stress enough, and I believe that John and I are going to talk about this topic more in early 2020, but we can't stress the importance of buy-sell agreements, management agreements as between people involved in corporations, especially when there's multiple owners. The other things are just your basic requirements under California law to have a corporation. Like, do you have a corporate binder? Do you have bylaws that are up to date? Have you prepared your annual minutes? It's very interesting. The question of annual minutes comes up a lot with my clients, and we encourage our clients to have annual minutes prepared each year. And for our clients who keep on top of it, it's really not too daunting of a task. They send us their corporate tax returns, we ask them a few questions, and in a relatively short time, their annual minutes for both their shareholders and their directors are produced. And that helps insulate them from piercing the corporate veil if someone tries to sue them and get at their personal assets. They can be hugely, hugely helpful. So moving along to another type of entity, we have the limited liability company. So LLCs are a very popular form of limited liability entity. Again, we need to make sure we have separate bank accounts and separate EINs for these. Did you make an S-Corp election? Even though this isn't a corporation, you can still make an S-Corp election. For some people, that's very tax advantageous. And again, the question comes up, do you have partners? When you start adding more than one person to a business, you really want to make sure that you dial things in. So if you have partners, we want to understand if it's manager managed or member managed, so we understand how you can take action on behalf of the company. And we really want to have a comprehensive operating agreement that really delineates management by sell, who has authority to do what can you do alone, and what do you need multiple, would you need approval of all the members, things like that. And again, also, have you made sure that the company's assets are being held properly, whether it's a corporation or an LLC? We really want to make sure that your business assets are owned by your business, that your personal assets are owned by you, or hopefully by a trust. So these are all important issues that, you know, I think this is a great time to start looking at. For corporations, we also want to make sure that your shares have been properly certificated, that you have a stock ledger that's up to date. You know, these are actually requirements under the law. When someone's trying to pierce the corporate veil and get to your personal assets, these are the types of things that your potential plaintiff is looking for to try to get at those personal assets. So we can't stress the importance of making sure that this stuff is up to snuff. For your LLC interest, most people don't certificate their LLC, and there's actually reasons why we discourage it in most cases. But if not, we do want to make sure that you have proper evidence of who the ownership is vested in. You want to make sure your books and records are accurate and complete. So those are also important things that you can do right now as you're getting ready for 2021.
Hey, Lisa, can I ask a question?
Sure.
What's the timing on establishing an entity for either a business converting from a sole proprietor to one of these entities? You know, in terms of doing it at year end, doing it early in the year, what's the timing and stuff like that?
So for any of our sole prop clients who, we have some that are sitting right now ready to file, what we do is we file those the last week of December for a January, I think it's a January 4th filing date. So the timing is, we actually love it when we have the client come in now to do it, because then we have it all set up and it's really just a matter of pulling the trigger when the time comes. And we send it off to our filing agent literally to walk in the very end of the year for that very first filing. Now, that doesn't mean we get it any sooner. The Secretary of State still usually takes 3 to 6 weeks to get them back, but it'll have that January 4th date so that your whole year will be in the, you'll be classified as a corporation that whole following year. So in terms of timing though, you could do a 24-hour filing even on January 4th if that's what someone decided to do. It's just that the Secretary of State charges an additional $350 fee for a filing that's a 24-hour filing. And if you want a same day filing, I believe it's $700 or something really exorbitant. But you can do it same day in certain circumstances. But if you plan now, you can be ready to go and it'll be the most cost effective come 2021.
All right.
So moving along, one of the things that people often forget about is where do you operate your business? So if you're a California corporation operating solely in California, fantastic. You don't need to worry about any other jurisdictions. But if you're a California corporation doing business, let's say in Wisconsin, you would want to have that limited liability protection, I assume, in the state of Wisconsin. But if you don't actually qualify as a foreign corporation in Wisconsin, you will not have the benefit of that. So when a business operates in multiple jurisdictions, one of the biggest holes I see when I'm evaluating my business clients is that they never qualify in the states in which they're operating. It's a really important thing and you really do have to do it. But California, if you have a business that's outside of California, that's registered outside of California, but you have neglected to register in California, that's where you have your biggest problems. Number one, the California Franchise Tax Board has zero problems trying to get at that $800 a year tax that they take so easily each year without any regard for anything else. So if you're operating in California and you're not registered here, you are making a big mistake. And I had a client who had a huge amount of money levied from them for this reason, and it was not fun. It was a big mess. So we cannot encourage you enough to really make sure you're evaluating these issues. Where are you doing business? Are you registered there? Have you thought about this carefully? And I'll tell you, the client that had that levy issue did not think they would have an issue. They were a brick and mortar business in another state, but the shareholder was based here, and it was caught, and it was a rather substantial tax liability that had to be dealt with because the shareholder operated for about 10 years in another jurisdiction. And actually, we felt had a strong argument as to why they shouldn't be required to even deal with California at all. But California absolutely refused to consider that the shareholder, because the shareholder was entirely based in the state of California, did not conduct any business here, and therefore they were required to pay the $800 tax each year, plus penalties, plus interest. It was not good. So I can't stress enough the importance of that. So you just want to make sure you're up to date with all your required reportings, whether it be through the state or through the Franchise Tax Board. But yeah, you can move to the next slide. Sorry, John. The other big thing that you can start looking at as you're, evaluating everything for 2021 is, have you really properly handled management and asset protection issues? So one thing, a lot of people have corporations or LLCs that are in their individual names, but they might own a trust or they might have a trust. If you have a trust, most of the time, your assets should be registered in the name of your trust. And the reason for that is because oftentimes people don't realize the value of their businesses. But if your business is valued at a certain threshold, which is about $160,000, give or take, with the state of California, under the state of California probate rules. If your business is worth more than 160,000 and your shares are owned by you individually and you die, you will most likely need a probate unless you have taken the step of putting it in trust or have joint tenancy with right of survivorship or some other way around a probate to avoid having to have the asset transferred. Recently, I actually had to deal with this with a client whose shares were actually registered in the name of a trust that didn't exist. And the client was near death, and we were scrambling to fix this issue at the last minute so that we didn't have a probate situation. I cannot stress the importance to you of making sure that there is a transition plan laid out and properly organized and properly papered up so that your family and next of kin is able to do what they need to do in the event that something happens to you. And unfortunately, business owners are so busy dealing with the business that they often forget these issues, and it becomes an issue at a time when you're just not well equipped to handle it, like you're in a coma, or you've had a terrible car accident and now you need someone who can access payroll or do whatever, and you've made it so that they don't have the ability to do that. So the trust is one way to kind of keep the chaos at a minimum. So if you know you own a business and you know it's in your name and you also know you have a trust, there's really no reason to not get those shares reissued, with some very narrow exceptions. So talk to your professionals about this and ask their thoughts, but it's important. Also, one of the other things that I saw a lot in 2020 was with the stoppage of work, with the closure of businesses, there were a lot of issues with collections for many of our clients, and some of our clients incurred fees and having to collect from businesses who weren't paying. And oftentimes I hear, well, I don't want to settle for just the amount owed. I want them to pay lawyers' fees. And I'm like, well, let's talk about that, because under California law, except for in very rare circumstances, you don't have the ability to get attorney's fees unless you have an express provision that plans for that. So I'm looking at terms and conditions for purchase orders, and many of my clients completely don't have any terms and conditions associated with their purchase orders. And if they do, they're missing attorney's fees provisions. Well, that's a problem. I would get that stuff, really solidified for this coming year, so that if we ever have something crazy happen like this again, you know that you have a way to get at your attorney's fees, to also make sure that jurisdiction is where you want it to be and not where they want it to be. If you're placing a purchase order with someone based in New York, I mean, you're going to probably have to go to New York to collect. Well, that's a huge undertaking for most businesses and much more costly. So these are things that you want to think about. With COVID especially, everyone's using the internet at a crazy pace. Is your privacy policy up to date? Do you have terms and conditions that explain to your end user how things work, and how liability is allocated if there's a loss for some reason? Terms and conditions and privacy policy is required under California law if you're obtaining certain information from your end user. So you really have to have most of these in place. This is a great time to start having these reviewed, make sure they're up to snuff. Also make sure you're limiting your liability correctly. So I think that that's something that should be looked at as we approach the year end. The other thing that people often neglect to consider, but is a really important thing to think about, are your trademarks, your copyrights, patents. I didn't include them because we don't do patent work, because you have to have a special license for that. But that's a hugely important issue as well as just intellectual property matters in general. The first question is, should your business name, your goods, your services, should those concepts be trademarked? Or are they trademarkable in the first place? And if so, should they be? Now, some people take the stand that they don't want to trademark that, but if you have something that takes off and you don't have a trademark, you know that there are people who are just chomping at the bit to copy you. So that's a really important issue. Also, one of the things that we see so commonly, and I always just get the most disappointed looks from people when they find this out, but if you start a business and you're using a name that is a trademark, that infringes on someone else's trademark, you could potentially be sent a cease and desist and be forced to change the name after you have spent considerable dollars marketing already. That is a absolutely bad use of your funds. And frankly, it's going to cost you far more to act reactively than it is to act proactively on these matters. So if you're in the infancy stages of starting a new business, I can't recommend enough that you do a trademark search and see what else is out there on the proposed name. I just got hired to do a series of new trademarks for a client. And the first one I pulled up, the client came in and was like, I've checked all these out, we're good to go. But what the client didn't realize was that people often change the way something is spelled. For instance, like organic, they might spell organic with an X at the end. There's a lot of play on names that happens, which are, when we do the searches, we will find, but often people who are lay people who don't do this day in and day out, they won't find it. And if you don't find it, and let's say your name is, I don't know, let's call it natural organic, and then you put natural organics thinking, well, I'm making a little change, you could still have a trademark issue. So that's why you really do want to do these searches in advance and make sure that your name isn't going to cause any problems. Also, one of the things that we see a lot are people working for you. You know, do you have proper work for hire agreements in place when you're having people who are creating content or creating things that are otherwise copyrightable? Are they going to lay claim to what they're creating on your time at your dollar? You really want to make sure you have these in place. Now, some of this is employment related, and you can have this set up when you're, onboarding someone as a new employee. And I'm not going to get super in detail on employment related matters because Brian is going to get into that. But I do really recommend that you think about these things when you're taking on a new employee and what it is that employee is going to do for you. The other thing is that if someone is using your trademark, do you have a proper licensing agreement in place, or are you proper licensing? You just don't ever want to get sued for these things. They're expensive to litigate, and it's something that is very easy to set up in advance so that you're properly planned. And that's it for today, for me.
All right.
Perfect. Well, thank you both for that. And as Lisa mentioned, just to give a quick, before we get into the question and answer portion, as John has up on the screen right now, we do have our annual employment law coming up. And so we have that one scheduled for January 14th. And just to go into just a quick background on what's going to be discussed, Brian Koegle and Lisa, correct me if I'm wrong on pronouncing his last name, Michael Fostakowski. They will be discussing updates on COVID-19 regulations in the workplace. They're going to talk about the changes in the independent contractor classification, which we saw a lot go down this year with wage and hour law updates with best practices. They're going to review the latest leave laws, expanded leave for smaller employers who have 5 or more employees, mandatory reporting requirements for employers, and then just pretty much preview any new laws for 2021. So that is up on our website for you to register. You do have the option. I know it's virtual, so we've actually had a couple people reach out to us thinking it's a typo. It is virtual, but we still have a ticket option for lunch. So we are working on coordinating lunch for you guys. The networking portion will start at 11:30 with the actual program starting at noon. So if you wanted lunch, there is a ticket option that does include that. So if you go on our website to register, you'll be able to see it. With that, I want to thank John and Lisa both again. We'll go into a few questions. We've got a few questions that come up, so we'll go into that. John, I'll go ahead and start with you. And this is kind of a 2-part question that I'll put together. In regards to 401k, I know there's a new law for June of next year and then June of 2022. So if I have less than 5 employees, I guess first part of the question is how soon should I start? And then the other part of the question being, if June 2022 is the deadline, what's the latest I could start? How long does the process take, I guess, pretty much?
Yeah, but part of that question was if I have less than 5, right? So if you're less than 5, you're okay. So if you're 4 or fewer, you're not required to. But required is an interesting term, right? Because I would encourage most people, individuals, should be saving for retirement, right? That's a good goal that all business owners should have. Now, whether you're forced to by California or not, generally that's a good financial planning discipline to have as a business owner, is to start putting money aside for yourself. But a lot of times, what happens is when we're sitting down with individuals who are contemplating this, we really want to ask, well, what's the purpose? Why are you doing this? And so sometimes it's, I want to have a nice employee benefit. I need to attract employees, so I need a competitive plan. Some of it is I want to save taxes, right? So there's reasons why people establish these. And so if you're less than 5 now, you're okay, but I would still encourage you to go down that path and find a plan. But if you're going to maybe breach that and you're going to be at 5 employees by June, putting together the 401k at minimum, in my estimation, you should give it 4 months. You get too close to that, you're going to be scrambling. And I think as business owners, we hate when we're kind of rushing at the last minute, because that's when mistakes are made. So I'd really encourage you to start now. Even if you don't put the plan in place this year, at least you have a better understanding of what it entails, what the costs are, how to plan for that in your budget, and then also craft it appropriately for what you need and what your employees might need.
Cool. John, do you happen to know how that's going to be regulated? Like, do business owners, do you know if they're going to receive like some sort of form from officials, or do you know what's going to happen?
I don't know all the nuances, but essentially it's going to be one of those things where you can imagine it's a daunting task for California to track down every business and make sure they're complying. So there's some heavy fines. I didn't list that on the slide. I actually don't know off the top of my head. The fines are pretty steep at a per employee basis. If you're not in compliance within 90 days and then 180 days. So the fines can be pretty steep. That's really easy if you want to Google Cal Savers fines. I would encourage you not to have the fine issue, but some people might either knowingly go into this and not set it up and pay fines later, or kind of not be aware of it, and they're gonna get hit with these fines. So the cost of an of a 401k is far less than the fines are going to be, so it seems silly to allow that to occur.
Cool. Lisa, I'll go to you. During your presentation, you mentioned about having to be registered in each county that you do business with. Is there kind of like a go-to? What if somebody's been in business for a bit, not realizing they've expanded? How, where can they check and see if they are registered in other counties?
Oh, that's simple. You just go to the county. If you Google the respective county, like Orange County fictitious business name statement, you'll be able to pull it up and you can do a search. LA County is the one I'm most familiar with, simply because we obviously do most in LA County, although we do them all over because we have clients based all over the state. But I know with LA County, there's like a search place where you can do a search for the fictitious business name, and it'll pull it up. Now, it won't show you all of the details about it. So if there's 5 Vance Welts registered, which obviously there's probably not, but if there was 5 Vance Welts registered, you won't necessarily be able to see who owns them. That, to see like how they're registered or to whom they're registered, you actually have to go to the recorder's office to get that information, or we send a filing agent down there to get it for us. But it's a really easy way that for someone who's just expanded to, let's say, 3 or 4 counties, for them to get that information.
Okay. Sorry, so it is by county. It's not like go to the state and then you'll see Vance Welt and all the counties listed.
Correct. Some states do it differently, but California is by county.
Perfect. And then depending on the business type, so are professional services and all of those types of entities in that group, or is it based on certain types of businesses?
Really, most businesses that are operating under assumed names need to have it. So oftentimes, like even if I was just operating under Lisa Odom, like the law office of Lisa Odom, if that was my company name, I would be registered as a fictitious business name. But if you're just using your name, like if people literally just pay Lisa Odom, then no, you don't have to. But honestly, it also, most people who are operating under an assumed name, 90% of people who I meet who have sole proprietorships, probably actually 95%, need to have a fictitious business name statement registered. Very few are on the outside of that.
Okay. Lisa, just to stick with you, when you were talking about corporation statuses and, you know, being tax advantageous and filling all the correct entities with like the Secretary of State's office, the question is, what if you're a self-proprietor but have an online business doing business nationwide? Does that make a difference, or how would that work?
So the question is, if you are not a registered entity, you're a sole proprietor, but you have an online business which has, so in that case, it really depends. Probably most people are probably not registering in every single jurisdiction across the country. That's where your terms and conditions can really help you. The terms and conditions basically say, hey, in order to do business with my site, you're coming into California. And that's probably, I would say, how 95% of people handle it. It really depends on the company, though. Obviously, like, you know, your Best Buys of the world, they're registered everywhere.
Mm-hmm.
But for most people, they don't register everywhere. But then the terms and conditions really specifies that you understand that you're coming to California, that you are voluntarily coming in here to do business. So whether it ultimately works, if there was a product liability issue or not, that's a whole other can of worms. I mean, you have to be practical too. If it's going to cost you, you know, millions of dollars to register and you're making 100,000 a year, who's going to do that? So this is why it's a very case by case basis. So people who are operating nationwide have just different issues that are unique to them, and that's why theirs is a little different.
Okay. John, just to jump back, we just got this question come in, just to jump back to the retirement plan. Is the retirement plan also required for part-time employees? Oh, John, you're on mute, sorry.
Rookie mistake.
No.
So it depends on how many hours they work. So depending on the type of plan, like SEP IRA plans, if they have, it's like $500 of pay over 3 of the past 5 years, they qualify. So that's clearly, it could be a part-time person. Most 401ks generally you can exclude people under 1,000 hours. So once you breach the 1,000-hour mark, then they are eligible. But there's different requirements. That all comes into plan design. So, you know, if you're going to set up a 401k, you can have a 401k that new employees are immediately eligible. You can set it up where they're not eligible for 1 year and certain number of hours worked. But generally with 401k plans in particular, once you get above that 1,000-hour per year average, once you qualify, then you are eligible for the 401k.
Okay. Does that, John, is that required that, like, for example, the 1,000 hours, or can you, like, for example, for your company, can you start an employee's 401k on day one? Because I know generally you see it like after X amount of months, like usually after the 3 months, your health care will kick in, and then after a year, your 401k will kick in. Is that just standard, or can you go into a company that does it all by day one or does it all a year later?
Yeah, so generally, so those are all provisions in the plan document that you set up ahead of time, so you get to design it how you want. Generally, it's not day one because it's cumbersome to employ somebody, and if they're not the right fit, then you just don't want them in the 401k right away. But you can set it up right away, and then I believe the latest time is 1 hour, or excuse me, one year. You cannot go longer than 1 year.
Gotcha. Okay. Just to kind of switch it up a little bit, and I guess this question can kind of go for both of you. But, you know, being the webinar titled, you know, hindsight is 2020, or how some people say, at least I know I always say it, we all have 2020 hindsight. What would be a piece of advice that you'd have given yourself at the start of this year, seeing how 2020 has played out on the business side of things, you know, more so? And then I guess if you can also say, knowing how this played out, what would you tell yourself January 1st, 2021 to immediately do? Whichever one of you wants to kick it off first.
You go first, John.
Okay. So a couple things. You know, from a business perspective, I think COVID was a really healthy reminder to have cash, to have lines of credit. to be in a position where if you have disruption in business, that it doesn't shut you down. We got lucky. I mean, we had PPP, EIDL money, stimulus checks. It came fast. Our government acted in a remarkable way to get this money out. So that was a really healthy reminder of make sure you have cash, because it does two things. It gives you that, it allows you the ability to move forward and know you're okay and you can keep operating your business because you have reserves. And then, it just allows that confidence with your employees, because they're not wondering, okay, are my doors going to shut tomorrow? So that cash, and the idea that I've been looking at, and not every business can do this, but if you can have around 2 years of cash reserves or line of credit, you can weather most storms. That's a really important number. So that's probably the biggest thing, that my biggest takeaway. The other piece that I would advise people is if you're going in, if you're taking payroll on a regular basis from your company as a business owner, and you're going to have a down year, you might want to pause your payroll temporarily and review at the end of the year, because you can always give yourself a bonus payroll. If you don't pay yourself enough, you can always get in the fourth quarter and do a much bigger number if you have to catch up, but you can't undo it. So if you get to the end of the year and you're like, wow, we shouldn't have made these decisions. And so I think what I would have done is, we've been in constant communication with clients about these issues, but with our business owners, I would have probably alerted them all at the beginning of this, hey, take a pause on payroll right now, and then let's reassess, once we get a little bit more clarity.
Gotcha.
I would say for me, one of the things, I would actually talk more about the planning side of things with respect to what is your plan if something catastrophic happens to you as a business owner. I think that was one of the craziest things that I saw this year. It's odd. I did not have any COVID related deaths, or at least none that were ever ruled finality COVID related. But I had a lot of deaths that I had to deal with in 2020. I have an overlapping business and estate planning practice. So I was dealing with a lot of deaths this year that were shocking. They were people who died young or younger than we would have normally anticipated. They in their normal lifespan is much longer than when they expired. So the ones that had businesses, there was a lot of problems. There was a lot of things that weren't set out properly. There was a lot of things that might have been pending. And the biggest thing was dealing with even that interim period, maybe when they were in the hospital, and trying to keep things moving with business especially during the pandemic, was really difficult. And without this plan in place, like without a business succession plan, that was really, really challenging. So the upside of 2020 was that I was able to get a lot of my best clients in here to start thinking about business succession planning. And they all had very real understandings of that, because they saw what happened to so many businesses during this period. So we've done a lot of business succession planning, and that is going to be the focus of John and I's next chat, is because it's so critically important. But if I were telling a business owner anything that I think is really important as they're gearing up for next year, is to make sure you have your plan in place, both personally and on the business side. But it's too late when you're sitting in a hospital, with a ventilator in your, going down your throat. Like, that's not the time to do this, obviously. And I'm not trying to be insensitive, but it's you don't know. You don't get a crystal ball to tell you when the time is to plan. And this is one of most people's most valuable assets when you are a business owner. It's a hugely valuable asset. So to not have this stuff in place, and not to have been thinking about it, and not to have at least even just a power of attorney to let someone step in to your shoes for a small period of time when you're unable, is really kind of crazy when you have this asset that has potentially so much value. So that would be my probably hindsight, that would be the most valuable thing that most of our clients could have done at the beginning of this last year, but certainly can do for next year. It's never too late to plan. So.
Perfect. Well, I failed on moderator skills 101. That would have been a great closing question. I should have just saved it. But I do have one more question for you both, actually. And this, again, I don't know, both of you can take it, or if one thinks the other one can answer it. You're hearing a lot of businesses wanting to move out of the state right now. And I know certain businesses, I mean, especially during COVID, I think a lot of businesses realize that they can work from home. You know, they don't need a physical office. It's okay to just take a quick flight out if you need to meet face-to-face with clients, but we don't know when that's going to happen. And with Zoom, John, correct me if I'm wrong. I know you're not necessarily a tax professional, sort of say, but to see what you can speak on this, and Lisa, if you can kind of speak on the legality of it, is if a business, for example, I own a business here, but I want to move to Florida. A lot of my operations are still here. How does that work if I want to move there because taxes are lower there, but a lot of my business is still kind of being done here, but I don't physically need to be here? Again, I don't know kind of which one of you can take this one or both.
I can start, but that is really a question for a tax professional and more importantly, probably a tax attorney. The rules on this are very specific. California has their clause in you. So even if you think you're gonna go relocate to Nevada or Florida or a tax-free state, there's a bunch of qualifications about where's your largest piece of real estate owned? Is it in California? Okay, we might still tax you here. What percentage of your business operation is in California? So California, by default, kind of has this attitude that you're still a resident here, even though you moved, unless you can prove otherwise. And so before you think it's just super easy, make sure you vet that with somebody who's dealt with a California court and understands the rules, because while it might sound like common sense to the three of us, when you get in there, California has a whole different viewpoint on that.
Yeah, I would say that, especially just to echo what John said, that really does need to be considered by a tax professional, because if you're wrong, you're going to pay a lot of money to fix it. From a legal perspective, if you're still operating here, you can move your business to Florida, but if you still have operations here, you still have to be registered here, and you're still going to have to pay that California tax. So a lot of times it's not necessarily advantageous, depending on, I mean, maybe for you on your personal income, yes, but it's not going to get you away from California. California is probably one of the most aggressive states in terms of getting their claws in you from a tax perspective. And you still would have to be registered here to have the protections of limited liability. So I don't know that it really does you a lot of good. If your business is here and you're based here, I suppose you could try to find a way, but the IRS, when people do this, because people are constantly asking me about Nevada, because obviously that's a very close by place. You can get there in a few hours, but they will check your records. They'll check your phone records. They will make sure you were in Nevada 51% of the time. So don't do it unless you actually think you can make good on it. It's
gas receipts. Yeah, I mean, they'll check gas receipts. They'll check, did you change your doctors? All of these normal things. And so if you're gonna do it right, and don't try to skirt it just for the tax issues, because you might find yourself in trouble.
Exactly. I would agree with that. I would basically proceed with caution, big time. So
cool. Well, perfect. Well, thank you both so much. And for myself, on behalf of the chamber, I want to thank both Lisa and John for being here. Thank you to everybody who attended and tuning in. As Lisa and John both mentioned, there is going to be another part to this webinar in January. We'll send the details out with that once we've got it finalized. And so you'll be able to find that on our website, on our emails. And again, we'll share that both. If we didn't get to your questions, or if something else comes up that you think of, please email me personally or email hello@scbchamber.com. I will do my best to get your questions over to Lisa and John, and we'll get you the information that you've requested. The chamber is continuing to work for our business community. As you know, we're constantly advocating for a healthy business climate. We're trying to ensure our businesses are covered during this time. Just to remind you all, we do have our COVID-19 resource page on our website. Please make sure to visit that. We are constantly updating it with the resources and information that are being available to our state, county, city, and everything. With that, please be safe, healthy, and we look forward to seeing you all virtually soon. Thank you, and Lisa and John, thanks again.
Thank you so much. Have a good one.
Thanks.
Bye.